You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. We've got a fascinating stack of global intel today. Briefings covering everything from FX and commodities to some pretty specific trade policy shifts and, of course, geopolitics.
Right.
Our job, as always, is to connect the dots for you, distill the key insights, and really give you that shortcut to understanding what's driving the markets.
And what really stands out this time is how, interconnected everything feels. It's not just one thing.
Right.
We're looking at, I'd say, three main pressures hitting all at once. You've got crucial U.S. economic data on the horizon.
The jobs report, especially.
Exactly. Then there are these shifts in global supply chains, particularly in energy. And layered over all that, escalating policy friction and geopolitical hotspots flaring up.
That's the challenge, right? Connecting something specific, like gold hitting a record high, back to the underlying why. Is it U.S. fiscal worries? Is it a new tariff threat? That's what we need to unpack.
Precisely. And the tension is palpable right now. You see it immediately in the financial backdrop. The dollar has actually eased off a bit, as markets are just hesitant ahead of this massive data dump later in the week. Everyone's eyes are on Friday's U.S. jobs report. And critically, you've got this shadow of domestic political risk. The White House is actually warning a government shutdown is possible again.
So fiscal worries are front and center even before we get the big jobs numbers.
Absolutely. Fiscal policy is setting the tone right now.
Okay, let's start there then with the currency markets. The dollar index, you said, slipped back below the 98 handle. For listeners maybe not watching FX screens daily, what does that actually signal, slipping below 98?
Well, fundamentally, it signals caution. A bit of a retreat, maybe. The 98 level was acting as a kind of floor, technically and psychologically.
Right.
Slipping below it means investors aren't really willing to make big directional bets on the dollar right now. They're waiting. The market's completely in data dependency mode. They want to see the ISM surveys and, crucially, those non-farm payrolls that play NFP numbers.
So this hesitation in the dollar must be causing ripples elsewhere. What are we seeing in other major currencies?
Yeah, there's nuance across the board. The euro, it edged a bit higher, but it was quiet trade in Europe. It's mostly just benefiting from the slightly weaker dollar.
And sterling?
Sterling held pretty steady, actually, above 1.34. There wasn't much major UK news driving it, so it was kind of stable by default.
Okay, but here's where it gets interesting. Connecting back to that policy risk, the Japanese yen. It firmed up quite noticeably, pushing USD JPY down through 149 intraday. That feels like a significant move.
It is significant.
Yeah.
And it's fascinating because it's not just one thing driving it. It's like a convergence of risks. Japanese markets are bracing for a really pivotal few days. You've got the Bank of Japan's Tankan survey coming out. That's a key pulse check on business sentiment.
Right.
Then, like everyone else, they're watching Friday's U.S. jobs data, which impacts global rate expectations. And on top of all that, there's a leadership vote happening in Tokyo this weekend. So it's this mix of economic data, global rates, and domestic political uncertainty all hitting at once.
Wow, okay. A perfect storm for yen caution. Meanwhile, looking east, things seemed a bit more stable. The yuan.
That's right. The yuan actually found some decent support. It got a boost from a stronger than expected fixing by the PBoC, that's the People's Bank of China, setting the daily rate. And that came just before China heads into a long holiday week. So it suggests maybe some internal effort to keep things stable before market liquidity things out.
So pulling this FX block together for the listener, the main takeaway still seems to be, watch the U.S. labor data on Friday. Unemployment, wage growth. That's going to be the key driver for the dollar's next move, isn't it?
Absolutely. It sets the stage for everything else we're about to discuss. The dollar's the linchpin.
Okay, shifting gears to commodities. We're seeing this really interesting split screen. Energy markets looking a bit defensive, while safe havens like gold are, soaring. Let's start with energy. Crude prices eased off. Why the relief there?
Two main things, really, both related to supply expectations and logistics. First, our sources suggest OPEC Plus looks likely to agree on increasing production quotas at their meeting on October 5th. maybe by at least 137,000 barrels per day.
Okay, so more supply potentially coming online.
Exactly. That expectation alone takes some heat out of the market. And the second reason is more concrete, a logistical fix.
Ah, the pipeline.
Correct. Iraq has signaled that flows through Turkey's Ceyhan pipeline are finally set to resume. They're projecting maybe 180,000 to 190,000 barrels per day initially.
That's quite a chunk of supply potentially returning.
It is, and you even have Iraqi officials talking about scope for more exports later as new projects come online. So the market sees these blockages potentially clearing, and that's naturally pulling prices down a bit.
That seems as positive news for supply. But zooming out slightly, are logistics still fragile elsewhere? I saw notes about European gas.
That's a really important counterpoint, yes. European gas logistics are still pretty fragile. We saw force majeure notices, basically contractual get-out-of-jail-free cards due to unforeseen events.
Like strikes.
Exactly, like strikes. Those were cited at several French LNG terminals, and it's limiting how many ships can actually dock and unload. So yes, crude might be easing, but gas import infrastructure in Europe still looks vulnerable.
So the market might be focusing on the good news in oil, perhaps overlooking the fragility in gas.
Could be.
Yeah.
And this whole environment, the softer dollar we talked about, plus the geopolitical jitters and that U.S. fiscal uncertainty, it just creates the perfect setup for safe haven assets.
Which brings us to gold, advanced to fresh record territory. Trading above $3,800 an ounce, I mean, that's just a stunning number.
It's a phenomenal run, and you can really tie it back to three key drivers from the source material. One, the softer dollar, obviously, makes gold cheaper for buyers using other currencies. Two, those persistent global geopolitical tensions, which we'll get to. But honestly, the most immediate, powerful driver seems to be number three. That lingering, very real uncertainty around U.S. fiscal policy, that shutdown warning we mentioned.
Right.
When government policy looks paralyzed or just unpredictable, investors often make a beeline for assets totally outside the traditional financial system. Gold is the classic example.
So gold is basically pricing in the risk of political dysfunction in Washington. Makes sense. Did the weaker dollar help other metals much? Copper?
Copper got a little bit of a lift from the dollar pullback, which often happens. It's an industrial metal, so a weaker dollar helps. But that broader risk-off mood, that caution we mentioned, it really capped any significant gains. Traders are nervous. They prefer the safety of gold right now over a cyclical bet like copper.
Okay, let's pivot to trade policy.
Yeah.
Tariffs are definitely back in the headlines, and the thinking seems to be getting much more granular. Washington is apparently looking at a new way to tax imports based on the number of chips inside electronic devices.
Yeah, this is a potentially huge shift. Instead of just taxing, say, the whole imported laptop based on its value, they're considering taxing it based on how many critical semiconductor chips are inside it. It's a very targeted approach.
Why do that? What's the goal?
The goal seems to be about securing domestic supply chains, right? By making imports that rely heavily on foreign chips more expensive, you essentially penalize companies for not sourcing or making those chips closer to home. It's industrial policy via tariffs.
And we also saw some clarification on pharmaceutical tariffs, which really highlights how tariffs are being used as a bargaining chip.
Absolutely. The administration basically said proposed tariffs won't hit countries that agree to certain price caps. They mentioned a 15% ceiling for the EU and Japan.
Okay.
But here's the stick. The UK, if they don't strike a deal, could face 100% duties. That's a massive threat. And apparently, London is now considering just paying more for U.S. drugs to avoid those tariffs. It shows the kind of pressure these policies can exert.
And this tougher trade stance isn't just aimed at Europe or specific sectors, right? The trade temperature seems high across the board.
Definitely. Look at India. Talks are happening, described as constructive, but progress seems clearly tied to India giving U.S. companies better market access and cutting back on its purchases of discounted Russian oil.
So linking trade directly to geopolitical alignment.
Exactly. And elsewhere, South Korea apparently pushed back against a U.S. request for a big cash payment as part of some tariff deal. Plus, U.S. soybean farmers are reporting China's halted purchases again amid their ongoing disputes.
And even within Europe.
Yeah. Brussels is reportedly considering getting tougher on UK steel imports, maybe tighter quotas, higher duties. The big picture here for you is that trade isn't just about moving goods anymore. It's increasingly about controlling strategic supply chains and using market access as leverage for broader foreign policy aims.
That leads us naturally into geopolitics, which is certainly active and influencing markets. Let's start up north, on NATO's flank. Some significant security moves happening there.
Indeed. There were reports of drone incursions over military sites, even airports in Denmark. And the response was pretty swift. Plans were announced for two things. First, a continent-wide network system to defend against drones.
Interesting.
And second, just generally beefing up the NATO presence in the Baltic states. It signals a very real concern about aerial threats and a push for a more unified European air defense posture.
And the conflict in Ukraine continues, sadly. More attacks from both sides.
Yes, the destructive pattern continues. Moscow launched another significant missile and drone barrage. In response, Kyiv targeted energy infrastructure inside Russia, specifically an oil pumping station.
Any immediate market ripples from that specific exchange?
Well, the most direct impact was Poland briefly closing its airspace during the Russian attack. Any airspace closure, even temporary, immediately affects flight routes, logistics, insurance costs. And keep an eye out, Kyiv is apparently expecting the EU to announce a new sanctions package against Russia this week. That will be important for assessing any further constraints on Russian exports, particularly commodities.
Moving to the Middle East, the White House seems to be pushing hard on a plan for Gaza. Reports mention a detailed 21-point plan to end the war.
Yeah, the reports suggest it's quite advanced, aiming for a pretty comprehensive resolution. The key elements mentioned include things like a permanent ceasefire, a phased Israeli withdrawal, setting up some kind of post-war governing body without Hamas.
A big ask.
Huge. Plus, a massive international fund for reconstruction, and crucially, a pathway towards eventual statehood, but tied to significant governance reforms. It's incredibly ambitious.
Ambitious is one thing, achievable is another. What are the sticking points mentioned?
Well, while the talks are described as advanced, Israeli officials themselves acknowledge there are still significant gaps with Washington, particularly on the end state terms. And that's critical, because even if the U.S. has a plan written down, if the key parties aren't fully aligned on the final goals, especially things like a permanent ceasefire and withdrawal, actually implementing it step by step becomes extremely difficult. How quickly can this really move forward? That's the big question.
And just rounding out the geopolitical picture, two other brief but important notes. The UN sanctions snapback on Iran is looming, with Tehran saying it won't give up nuclear energy.
A persistent risk factor there.
And there was also that tense incident over the weekend involving maritime warning shots on the Korean Peninsula. Both just serve as reminders that these underlying structural risks haven't vanished.
Absolutely. Okay, that was a whirlwind tour of global pressures. Let's try and synthesize this now. What are the absolute critical takeaways the market is watching right now, the things that will move prices fastest?
I think the core dynamic is this tension between policy risk and supply risk. We see it perfectly with gold hitting records because of U.S. fiscal worries.
Right. Policy risk winning.
While at the same time, oil prices are easing because of potential supply increases from OPEC Plus and Iraq.
Supply relief winning there for now. So if we break that down into specific watch points for the listener, number one, clearly the dollar's reaction to Friday's U.S. jobs data, NFP and wages. A really hot number could slam the brakes on the dollar's recent softness and hit gold hard.
Number two, oil prices. Totally dependent on what comes out of that October 5th OPEC Plus meeting and whether those Iraqi pipeline flows actually materialize and sustain. Any disappointment there, and crude could snap right back up.
And number three, gold itself. Keep watching its trajectory near these record highs. It's basically the market's fever chart for global risk right now. Any sudden flare-up geopolitics in Europe, or crucially, a failure to fund the U.S. government, you'll likely see gold push even higher.
And connecting that last point back to immediate risk, we absolutely have to underscore the U.S. domestic political situation. The president's meeting with congressional leaders today about funding the government. The explicit warning that a shutdown is possible. That's not abstract. It's a concrete, near-term fiscal risk driving those safe haven flows right now.
Couldn't agree more. That potential domestic policy paralysis is arguably the single biggest global market driver at this exact moment.
So, thinking about loose ends and future risks, we touched on the UN sanctions snapback on Iran earlier. That feels particularly potent right now. Given that the market is juggling these new, very specific U.S. tariffs on chip counts, a real supply chain lever, and these major potential supply shifts from OPEC plus Greece, how do you think the formal snapback of international sanctions on Iran, a major oil producer, might scramble this delicate balance, especially if Tehran digs in on its nuclear stance?
That is the perfect question to leave hanging. because it forces you to think about how quickly that fragile supply relief in oil, which the market is currently enjoying from OPEC Plus signals, could evaporate if a major producer like Iran suddenly faces much tighter export restrictions again. It could completely change the energy price and geopolitical dynamic in the coming weeks.
A huge variable indeed, lots to keep track of. We certainly encourage you to keep exploring these interconnected themes.
Thanks for joining us for this deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.